your 401k never saved you $1 in taxes. It delayed them. And the person who gets to pick the date is not you. Here's what that costs in real money. Take Ron. He is 55, an operations manager, and he has $700,000 in his traditional 401k. Ron is doing everything right. He maxes it out every year, which at 50 and over is $32,500 in 2026. He's proud of that balance, and he should be. Run him forward. At 7%, Ron hits 65 with about 1.83 million. He does not touch it. By 73, it is about 3.14 million. And here is the sentence I want you to remember. That balance on his statement is not his balance. Part of it belongs to the government. Ron just has not opened the envelope yet. He does not even know the size of the bill because it will be set by tax rates that have not been written. Then the IRS knocks. At 73, the government forces you to start withdrawing. They are called required minimum distributions, and the amount is not up to you. Ron's account gets divided by a number from an IRS table. In his first year, that is 3.14 million divided by 26.5. Ron must withdraw $118,395 that year, whether he needs it or not, whether he wants it or not. And every dollar is taxed as ordinary income, exactly like a paycheck, and you cannot simply refuse. Skip a required withdrawal, and the penalty is 25% of whatever you fail to take. It drops to 10% if you fix it fast. This is not a suggestion from the IRS, it is a bill with a due date. Now sit with what that means. Ron spent 30 years deferring tax at 22 or 24%, and he could end up paying it back at 32. He did not avoid a tax bill. He bought one on credit at an interest rate somebody else gets to set decades later. That is the tax bomb. And the smartest investors in their 50s are not stopping their savings. They are stopping the habit of feeding one single bucket. The whole 401k pitch rests on one promise. You will be in a lower tax bracket in retirement. For a lot of people, that promise is simply false. Think about who you actually are at 75. Your mortgage is gone. Your kids are grown. You have no more deductions and nothing left to write off. Meanwhile, Social Security is coming in, and a pension if you have one, and your forced withdrawals are stacked on top. For a good saver, retirement income can land higher than working income, and the deductions that used to shield you are gone. So the deal you thought you made was defer high, pay low. The deal you might actually get is defer low, pay high. Let me kill the clickbait version of this right now, because I am not going to let you hurt yourself. Nobody smart stops taking the employer match. Nobody. That is free money with an instant 100% return, and walking away from it is the dumbest move in personal finance. Take the match. Every year, forever. What changes in your 50s is where the next dollar goes after the match. I'm Tom. This channel is about real personal finance, the kind that actually works for normal people, not the kind that gets you to click a thumbnail. No motivational fluff or fantasy returns. We just discuss what the math actually does over time. If that's what you want, hit subscribe. Now for the question nobody asks. Why does this change in your 50s specifically? Why not at 35? Here is the honest answer, and it is more interesting than the usual advice. At 25, you have no idea what tax bracket you will be in at 75. None. So the pre-tax 401k is a completely reasonable default. You are guessing, and it is a sensible guess. Your 50s is the first decade of your life where you can actually compute the answer. You can see the balance. The trajectory is visible now. Take your current number, grow it forward, divide by the IRS table, and your future forced withdrawal appears in front of you. The information finally exists. So the behavior does not change because the 401k got worse. It changes because you can finally check. And the timing is not a small detail. This decade is the last one where you still have levers. You can still steer new contributions. There are working years left to absorb a bigger tax bill today, and the conversion window is ahead of you, not behind you. At 72, almost all of that is gone. The balance is what it is, the table is what it is, and the withdrawals start whether you looked or not. Your 50s is the last decade where looking actually changes the outcome. And almost nobody checks. Most people run a default they set at 25 on autopilot straight into a tax bill at 73 that they never once modeled. Now here's the part that surprised me most when I ran it. and is the thing that makes this urgent. You cannot outrun the required withdrawals by simply not spending the money. Watch Ron at 73. The forced withdrawal is $118,395, but his account, growing at 6%, earns about $188,000 that same year. So he takes out $118,000 and the account still ends the year bigger than it started, which means next year's forced withdrawal is bigger, and the year after that bigger again. By 80, Ron is forced to pull about $175,000 a year. By 85, about $228,000. The account is chasing him, not the other way around. He is being pushed into higher and higher taxable income in his 80s by a decision he made in his 40s. The required withdrawal does not drain the bomb. For years it cannot even keep up with it. And now the bill nobody warned you about. It is called IRMAA. ERMAA is a surcharge on your Medicare premiums, and it is based on your income. In 2026, it kicks in above $218,000 for a married couple or $109,000 for a single person. Here is the cruel design. It is not a gradual ramp, it is a cliff. Go $1 over the line and the full surcharge for that entire tier applies to your whole year. $1. So picture Ron at 75. His forced withdrawal is over $130,000. Add Social Security. Add anything else. He sails past that line without doing anything except obeying a law. His Medicare premiums jump. He is being surcharged in retirement for the crime of having saved well, and the surcharge looks backward. Medicare uses your income from 2 years ago, so the bill arrives long after you could have done anything about it. There's a second hit riding along with it. Your forced withdrawals count as income when the IRS decides how much of your Social Security to tax. Push your income high enough and up to 85% of your Social Security check becomes taxable. You already paid tax on that money for 40 years. Now it gets taxed a second time, and partly because of a withdrawal you never asked to make. Now for the coldest one. Almost nobody sees it coming, and it is the reason careful planners take this seriously. It is the widow's penalty. One spouse dies. Let us say it is Ron and his wife survives him. Nothing about the money gets easier. The 401k does not shrink. Her required withdrawal does not shrink. It is the same account and the same IRS table. But everything around it gets smaller. She does not keep both Social Security checks. She keeps the larger one and the other simply stops. Her filing status changes from married to single, so the tax brackets she is squeezed into become far narrower. Same income, higher rate. And the IRMA line moves. For a couple, it sits at $218,000. For her, filing alone, it is $109,000. Cut in half overnight. Same house, same forced withdrawal, half the room to stand in. And this is not a rare edge case. One spouse usually outlives the other, which means for most married couples, this is not a risk, it is a scheduled event. She receives a tax increase for burying her husband. That is not an accident of her planning. That is how the system is built, and it is the single most overlooked risk in retirement. So what do the careful ones actually do? 4 things, and none of them is quitting. First, they take the match. That never changes, at any age. Second, past the match, they start steering new dollars somewhere else. The Roth 401k is the obvious place, and here's a rule change most people missed. As of 2024, Roth 401k accounts no longer have required withdrawals during your lifetime. Same paycheck deduction, same employer plan, no forced distributions, and no tax when it comes out. For a lot of people in their 50s, this is the entire fix, and it is one form away. Log into your plan this week. Look for a box that says Roth deferral or after-tax Roth. Most plans now have it, and most people never noticed it was there. Flipping that switch does not reduce what you save by $1. It just changes which bucket the dollar lands in. Your paycheck feels a little smaller now. That is because you are paying the tax today. The alternative is handing the bill to a 75-year-old who cannot argue with it. A Roth IRA does the same thing. So does an HSA. No other account in the tax code does all 3 things. The money goes in untaxed, grows untaxed, and comes out untaxed for medical costs. And a plain taxable brokerage account, which people dismiss, gives you capital gains rates instead of ordinary income rates, plus total flexibility. Third, and this is the one that separates people who plan from people who drift. There is a window between the year you stop working and the year you turn 73. Your income in those years can be remarkably low. No paycheck yet, maybe no social security yet, and no forced withdrawals yet. That window is the cheapest opportunity of your entire life to move money out of the pre-tax bucket. You convert some of that traditional balance into a Roth, you pay the tax at your low bracket, and it never gets taxed again. You are diffusing the bomb piece by piece on your terms at your rate. That window opens once. It slams shut at 73 when the forced withdrawals begin and stack on top of everything else. Most people spend those years doing nothing because nobody ever told them the window existed. And the conversions are not all or nothing. You do not empty the account in 1 year. A huge conversion would spike your income and trip the very cliff you are trying to avoid. You do it in slices. Each year, you convert just enough to fill up your current tax bracket, and then you stop. Same move next year. Ron has roughly 8 years between retiring and 73. 8 slices, taken at a low rate, move a lot of money out of the bomb, and you do it before the IRS gets to set the terms. Fourth, once you are past 70 and a half, you can send money straight from an IRA to a charity. It is called a qualified charitable distribution. It counts toward your required withdrawal, and it stays completely out of your taxable income. In 2026, you can move around $108,000 that way. If you are giving anyway, this is the most efficient way to do it in the entire tax code. So what does Ron actually do on Monday? He does not stop saving a dollar. The full $32,500 still goes in, and he keeps every cent of his match. He just logs in and moves his contributions to the Roth side of the plan. Same money leaves his paycheck. It simply lands in a bucket the IRS can never tax again and can never force him to empty. His take-home drops a bit right now, and that stings. But he stops adding fuel to a bomb that is already large enough. Then, the year he retires, he starts the conversions. Small slices each year, filling his low bracket and stopping. By 73, the account that would have forced $118,000 out of him is meaningfully smaller, and a good chunk of his money now sits in a Roth. No withdrawal is ever required there, and no tax is ever owed. None of that required Ron to save a single dollar less. All of it required him to look at the number once. Now let me draw a very hard line because this advice is genuinely dangerous if you apply it to the wrong person. The tax bomb is a big balance problem. It is not most people's problem. Think about my friends Carl and Linda in Pittsburgh. He was a plumber. She taught school. Their nest egg is modest, and their needs are modest. Run their numbers, and the forced withdrawal at 73 is small. It will not push them into a high bracket. It will not trip the Medicare cliff. For Carl and Linda, the pre-tax 401k did exactly what it promised, and there is no bomb to defuse. So here is the honest threshold. If your traditional balance is heading toward $1 million or more by the time you retire, this conversation is for you. Under that, it mostly is not. And if you are 50 with $200,000 saved, listen closely. Your problem is not that you saved too much in the wrong bucket. Your problem is that you have not saved enough. Keep maxing. The catch-up contributions are the strongest tool you have, and between 60 and 63, the limit climbs to $35,750. Use every bit of it. This video is not telling you to slow down. There is one more piece of honesty owed here. Say you are in a high bracket today, and you will genuinely be in a much lower one in retirement. Then the pre-tax deduction still wins. That spread is real money, and I am not going to pretend otherwise. And nobody knows what tax rates will be in 2050. Not me, not your advisor, not the guy on the podcast. That uncertainty is itself the whole argument. You do not know which bucket will be right, which is exactly why you should own both. That is what this really comes down to. You spent 30 years diversifying your investments. You bought hundreds of companies so that no single one could ruin you. Then you took every dollar of your tax risk and put it in one bucket. You bet your retirement on a future tax code nobody has written yet. The smartest investors in their 50s did not stop saving. They just stopped putting all their tax risk in one place. There's one more thing worth saying, because I know how this lands. If you're 55 and you just did that math, you might feel a little sick. Like you did something wrong for 30 years? You did not. The pre-tax 401k was the right tool for most of your career. It lowered your tax bill in your highest earning years. The match came with it, and it forced you to save when you probably would not have. That was real value, and you got it. The tool did not fail. You simply outgrew it. A balance that big was never the problem the 401k was designed to solve. And nobody sends you a letter when the default stops being right for you. That letter is this video, so do this. Go find your current pre-tax balance, grow it to 73 at 7%, divide it by 26.5, look at the number that comes out. That is what the government will make you withdraw in a single year, and it will be taxed like a paycheck. If that number is bigger than you would ever choose to spend, you do not have a savings problem. You have a bucket problem. And you have this decade to fix it. And do not let the word Roth scare you off. This is not some exotic strategy from a seminar with a free steak dinner. It is a checkbox in the payroll system you already use. The complicated part was never the move. The complicated part is that nobody in your life is paid to tell you the default stopped working. Tell me in the comments what that number came out to and whether it surprised you. I read every comment and I reply to as many as I can. And if you want the next video, hit subscribe. I'll see you in the next one.